Good morning and welcome to this Wednesday, September 21st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is Fed Day. Been waiting for a while now. We'll see what happens. The S&P 500, of course, recently lost 3,900 support. Been trying to hold in. We continue to see afternoons perform fairly decent after morning weakness. Today, actually, we've got a little bit of opposite action. We're seeing futures actually up a little bit, at least last time I looked. Dow futures, this was probably about 10 minutes ago. Dow futures up 144. S&P 500 futures up 20. NASDAQ futures up 52. So it does look like we'll get off to a decent start, but still within a trading range. Even with the futures up 20 points on the S&P, we're still below that 3,900 level. So I suspect that the trading today is going to probably be in a fairly narrow range until we get to 2 o'clock. And that's when the Fed will have its policy statement, where it is likely to announce a 75 basis point hike. I think that is pretty widely known. What's not exactly widely known is whether or not they're going to change any of their language or what language they're going to change. And I think the market's going to be extremely volatile after 2 o'clock. As a result of that, I'll show you a couple of charts, recent history a little bit later in the show, kind of detailing a little bit about what the history has been recently with the S&P 500 when we've had a Fed announcement. But again, we'll talk about that in just a bit. Right now, like I mentioned, futures look pretty good. Oil up $1.20, so we're up about just over $85 a barrel. The U.S. 10-year Treasury yield is down 3 basis points to 3.54%. Still, after setting another 11-year high yesterday, we are above that 350 level. And I think the question right now for me is whether or not we just simply get a relief rally in both the bond and stock markets. We've seen selling in both. Selling in the stock market takes the S&P lower. Selling in the bond market actually takes the yield higher. The price is lower, obviously, on bonds, but the yields actually move inversely all the time. So if you see the yield going up, it means that folks are selling bonds. And so whether or not we get a reversal after the announcement, just a relief rally in both bonds and stocks, I don't know. Very difficult to say. But I do think, I've said before, I'll say it again, I do believe that June low is going to hold. The market's constantly changing. I don't want to say that the stock market cannot go lower than 36. Of course, the S&P can drop below that level. We go back down to 2000. We go to zero. I mean, things can get bad enough, have a Great Depression. We could go, like we did back in the late 1920s and into the 1930s. It could be awful. I just don't see it. I don't see it in terms of the way the market's rotating. And so I believe that June low holds. We'll see. All right, let's go ahead. First of all, for those of you who are new, let me share my screen. And always like to start off, make sure everyone is aware, especially the folks that are new to the show. We do have a free newsletter. If you go over to earningsbeats.com, both plural, earningsbeats.com, and then scroll down, you'll see in the middle of the page, we have a sign up for a free newsletter. All it takes, name, email address, hit that subscribe button. There is no credit card required. You can unsubscribe at any time. It's a 3 times a week newsletter. I try to make it educational as best I can. There are trading opportunities if you so choose. Most of the time, it's looking at an individual stock and how that stock may be setting up. This morning, it was all about a company that had reported very, very strong earnings. Recently gapped up, traded up for a couple of days, actually for maybe a couple of weeks after earnings. And then many times these stocks will settle back down. They kind of go out of favor. They're out of the limelight for a while. A lot of profit takers take their money and run. And many times you'll get a second chance to get in at gaps support where the stock opened after earnings. And so that was one that was featured today. It's APH, by the way, for those of you who would like to look at the chart. And I think right around $71 or just about above $71, that's where that gap support resides. And I think stock's trading at 72 and change or something after getting up to 80. So it's made its way all the way back down to gap support. Anyway, that's the kind of thing that we do. It's a very brief newsletter. When I say newsletter, it's not like you're going through pages and pages. We're talking about 2 paragraphs in a chart. I think it would be a great addition to anyone's email to wake up and get that in the morning. Anyhow, just want to make sure everyone's aware. Go to earningsbeats.com, scroll down, you get that. All right, let's move on. Take a look at the daily market recap from Tuesday. Saw the Dow Jones Industrial Average down 313 points. S&P down 44, NASDAQ down 110. Mid caps down 40, small caps down 14. On a percentage basis, mid caps down 1.65%, small caps 1.25%. You got the Dow down 1%, S&P 1.13. NASDAQ was actually the best of those 5 indices, losing ground, but just under 1%. Not sure I'd read a whole lot of positive into that, but maybe a little bit short term. Looking at the sectors, all 11 sectors went down on Tuesday. So there were no pockets of strength. From a lagging perspective, real estate, once again, real estate has been so weak. I mean, if you were hedging and you're really worried about inflation, I say this all the time, but we get new folks coming in. I just want to make sure they're aware. Real estate is a hedge against inflation. If you're really worried about inflation, you want to make sure you have more than enough exposure to real estate, because as prices go up and all the materials that go into real estate go up, real estate goes up. So it's a way to hedge against the damage that inflation can inflict in a lot of other areas of the market. Look at what real estate is doing right now. Listen, I know the Fed's talking about inflation. I know everybody's talking about inflation. I know you go to the grocery store, prices are up. I get it. But I like to follow what Wall Street's doing. What are they doing with their money? They are not investing in real estate. Real estate now, all the way back down to the June low, beating the S&P 500 in that regard. To the downside, I mean, beating, not in a positive way. And it's spiraling down even faster here over the last 30 days. And I think one of the things the Fed should be thinking about doing is pausing, because when you start on a campaign of rate raising or rate cutting, it takes a little bit of time for that to actually impact the economy. You don't just announce it and the market just immediately does what you want it to do from those hikes. It takes time to go through the system. And so I believe the Fed is making a mistake by raising as fast and consecutively as they are without pausing to see what impact any of this is having. So I think we just have to be at least cognizant, not so much what the Fed is saying or doing, but how Wall Street's reacting. I think that to me is more important than the actual act of raising or cutting interest rates, because Wall Street's got a lot of MBAs and they're a really smart group, smarter than me, smarter than many of you. Some of you maybe have your MBAs, maybe brilliant as well. But Wall Street's got a bunch of really, really smart folks. They know what's going on. They know what's likely to happen. And they position their money based on what they believe is going to happen. They don't sit back and position their money based on what the Fed says. Many times they're doing the opposite of the Fed and basically telling the Fed that, hey, you're getting this wrong. I think that's what's going on right now. I think Wall Street's losing confidence in the Fed and is going and doing its thing based on what it believes rather than what the Fed is saying. That's just my interpretation, my opinion. Feel free to disagree. But when I look at real estate and I look at gold, especially gold, gold moving to 2.5-year lows. Gold is a great inflation hedge. And why it's at a 2.5-year low is mind-boggling with everyone so worried about inflation and talking about inflation. Makes no sense. So that's all I'm going to say about that. Materials down 1.9%. Discretionary down 1.7. Discretionary has been a stronger group on a relative basis. You can see holding on to its early September lows. The other groups, as you can see, have not. So this is and the overall indices have not. So discretionary showing some relative strength, which also is a little bit of a head scratcher. You got to be like, okay, well, Fed raising rates, that's going to help to exacerbate any economic weakness we have. If we're not in a recession, which I believe we are in, I mean, I don't know, 2 negative GDP quarters. But if we're not in one, keep raising rates when demand for so many things is already going down, I think is absolutely going to send you into a recession. You know, most of the time you hear about a recession after the market's bottomed. I think that's what will happen. We'll probably find out later into this year, early next year, that we went through a mild recession. That's what I believe. Anyway, but discretionary stocks are acting as though money is rotating into that area. Why would the market do that? Well, the market looks out 3, 6, 9 months. Obviously, it's liking a little bit more of what it's seeing in terms of how it's going to impact discretionary stocks. Communication services, on the other hand, very weak, continuing to break down to new lows. That's a bad thing, and that's a conflicting mixed signal. When we look at the way that all the aggressive groups are trading right now, yeah, discretionary looks really good. Communication services looks horrible, and technology somewhere in the middle. I would say maybe even leaning a little bit bearish. So we have mixed signals. This isn't a slam dunk by any measure. But I do like what's going on with discretionary stocks. I do like the rotation that's been taking place. I do like the afternoon buying that's been taking place as opposed to the morning selling. All of those things, I think, suggest that we're going to go higher. Anyway, financials also weak yesterday. Again, all 11 sectors were down yesterday, so it was not a very good day as everyone kind of braces for the Fed at 2 o'clock this afternoon. 10-year Treasury yield. So this is where we've seen a lot of selling of treasuries, sending the yields up. I mean, it has been a straight move up now for the last 6 weeks, maybe 7 weeks. And one thing that I've talked about is, you know, is this a real breakout? I mean, you got to respect it while it's breaking out. Just like to the downside, I thought we needed to respect this move to the downside until we got that big reversal, went through the 20, went through the 50. You know, I was talking about 310 being a key resistance level, went right through that, 325 through that, 348 through that, and we continue to move higher. We have to respect this. One thing I can say about the 10-year Treasury yield is it has been moving opposite the S&P 500. So if it keeps moving up, you've got to expect until something changes, you got to expect the S&P goes down. So what is the yield going to do today with this announcement at 2 o'clock? Is it going to be a relief rally? Is all the selling that has taken place in the bond market, are we going to see a lot of buyers coming in once we get the Fed behind us? That's a big question, not only for the bond market, but that will probably dictate what we see in the stock market. Now, just like we had this false breakout to the downside, is this a false breakout to the upside? I'm just asking a question. I don't know. We're going to find out. I mean, if we break down, start losing key areas like the 20-day moving average, it's going to start to look more and more like a false breakout. And if we do that, back to the downside, I think you're going to see a pretty good rally going on in equities. All right. Let's keep moving on. Let's talk a little bit about the S&P 500. So this is a 2-year chart. And there was a question that came in from a member at Earnings Beats. I wanted to address it here. You can see the S&P in 2020, 2021, just going straight up, up, up. And then we went down. We topped in January, beginning of January, and it's been a pretty rough year so far. Now, I have 2 indicators down at the bottom of this chart. One is the accumulation distribution, and the other is the on-balance volume. And if you notice, when we were going up, 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 the AD line was going up with it, as was the on-balance volume. They were all going up in tandem, all of them. AD line could not break out to a new high at the end of the year. OBV rolled over. And of course, the S&P started going back down. But look at what's happening in 2022. The S&P is going down. The AD line keeps going up. We just set a new high yesterday. and the OBV is going down. So they were going hand in hand. Now they're diverging. AD line up, OBV down. So what gives? What does this mean? Is it something to worry about? Is it something to go all in on? Why are they diverging? Well, the first thing you have to understand is how they're calculated. The OBV is very, very simple. Did the stock market close higher yesterday than it did the day before? Answer is no. Subtract the total volume. I don't care what kind of rally you made in the afternoon. If you finished the S&P 500 1 point lower at the end of the day, 0.01 lower, anything lower, take all of that volume and subtract it. If you finish 0.01 higher or 100 points higher on the S&P, doesn't matter. Take all the volume and add it. It doesn't care about where you traded during the day, how you finished, whether you gapped down, rallied, whether you started higher and finished just barely down. It doesn't matter. None of that matters with the OBV. Did you go up or did you go down for the day? Take the entire volume and either add it or subtract it based on where you finished, up or down. Very simple. AD line's a little bit different. The AD line isn't concerned about whether you finished up today or down today versus yesterday. The only thing it worries about is how you traded from 9:30 to 4 o'clock and where you finished. If you traded down 100 points, if your low of the day was down 100 and your best price of the day was flat and you finished flat, that means you finished at the very upper end of your entire trading range. You're going to take 100% of the volume and add it. Now, let's say for the S&P 500, let's say we gap down one day, 50 points. And then we go down another 50, so we're down 100. And then we go all the way back up to where we're break even. And then we come back down and close back at that down 50, right in the middle of the trading range. AD line, no change. You're literally right in the middle of your trading range that day. Now let's think about a really big, let's say you're rallying, and all of a sudden one day looking for a reversal. Well, let's say right here, this day in April, I don't know if you can see this big red candle where we gapped up. We were starting to uptrend. We gapped up above the 20, and then we finished down at the bottom of the day. Clearly, the OBV just takes all the volume and it's a sell. Well, we do the same thing with the AD line. We gapped up. We were trading higher intraday, but we came back down. We finished at the bottom of the candle or very close to the bottom of the candle. So both the AD line and the OBV are going to be the same that day. But if you've been following my show, you know I've been talking a lot about manipulation. The fact that we get lots of gap downs, and then we see morning weakness, and then we have afternoon rallies, balance of the day rallies. Well, if you think about the way the AD line is calculated, it's based on where you finish relative to that day's trading range. So if you have a gap down, like this candle right here, let me shorten this so you can kind of get a better sense of what's going on here. So these 2 days right here, especially this hammer. You see this hammer? It's on July, what is that, 14th, July 14th. That little hammer right there. Look at the AD line going up. And then come down to the 14th, and the OBV is going down. Why is the OBV going down? Because we finished below the prior day's close these days. OBV goes down. AD line's going up because we were rallying later in the day, and we finished at the higher end, the upper end of the trading range that day, almost right on the high. So on the AD line, all of this volume is positive. On the OBV, it's all negative. So when you look at this divergence here between the AD line and the OBV, you have to ask yourself a question. Do I only care about whether the stock market's going up or down? If you only care about the closing price versus the day before, and you don't care what happened during the day, OBV is your signal, because that's all it looks at. If, however, you look at this candle and say, wow, we had a big reversal off the lows of the day, in this case, came back up, held on to nice price support. I mean, to me, I look at that candlestick and I'm more bullish than I am bearish. So I think the AD line gives us the better signal. Being a candlestick fan, closing is pretty important on a candlestick. I'm going to be a much more of a fan of the AD line. And I'm spending a lot of time on this, but I think it's kind of important because, again, if we stretch this out and look at the 2 years instead of 6 months, you'll see that when we were going up, they agreed. They went up together. But in 2022, it's been very weird because the OBV keeps going down. The AD line keeps going up. I believe the AD line is supporting my argument that this is a cyclical bear market, not a secular bear market. Because I don't believe in a secular bear market, you would see buying in the afternoons. I think you'd be seeing selling all day long, or at least periods of selling all day long. Here, this is telling us throughout much of this year, first couple of months, we didn't really do much on the AD line. But starting in March, we had that big rally. AD line went up with it. We pulled back with this huge drop, but we never went back down to where we were on this drop on the March low. So you can see as we kept going lower and lower, the AD line was going higher and higher, telling me that there's accumulation taking place, which was another reason, one of the many, why I thought the market bottomed back in June and why I still think that's going to turn out to be the bottom. So anyway, everyone can look at that differently. And I'm not saying that my way is the right way. It's just my way. It's the way I look at the market. My interpretation. Technical analysis, there are a lot of experts in technical analysis, people that have studied it all their lives, and they don't agree when they look at charts. It's still very subjective. So I don't really look at this as being right or wrong. I think this is looking at this. I look at it as managing risk. That's why I do what I do. I try to manage my risk best based on what I'm seeing. I'm not trying to be right or wrong on every call, because if that's your bar, if that's your standard, if that's what your goal is, I hate to tell you, but you're going to fail at this, because no one is right all the time. No one is right most of the time. I mean, this is a very humbling job that I have. You can be right sometimes and look brilliant and look really dumb at other times. It's a little bit like the weather forecast. I'd like to think I'm a little bit better than the meteorologist, but the weather patterns change kind of on a dime, and you're trying to give a forecast of what they're going to do, and then they're pretty volatile and they kind of do their own thing. I think the stock market's very similar. You can look at all the patterns and look at history and see what it's done in the past when this happens, and it's an educated guessing game. Anyway, this is the NDX. Basically, I just wanted to show you the same thing, maybe not quite to the same degree, but you've got OBV going down, AD line going up. In 2021, it was the same. They all went up with the market. All right, last couple of Fed meetings, I just wanted to show, or at least I'm going to go back and show you the one that this was in May. I think they met May 3rd, 4th, and this was the announcement. So look at what happened. You want to talk about volatility and how you can totally be thrown off. Here is the announcement at 2 o'clock. Quick up, down, back and forth. Then we go down, then we go up. Then we have a big sell-off. And we come rallying back and finish the day really strong. And then look what happens after that. If you're trying to get clues from what happens after 2 o'clock today, I am just going to wish you the best of luck. Maybe take a rabbit's foot with you, a 4-leaf clover. It's really difficult. I think more important, it's what happens as the market reacts to it over the next couple of days. We're going to see some volatility. Here's the next one I'll show you. This was back June 13 or 14, 15. So you can kind of see this sideways action. If you go back here before this meeting, see all this sideways action right before the meeting, the announcement. So this is kind of what I'm expecting again today. Here is the after 2 o'clock announcement. Down, back up, down, big rally, more of a rally, then a little weakness, and then we go back down after that. And of course, the market, I mean, let's go out a little bit further here. Because after going down, then look what happened. That, in my opinion, was the last hurrah to the downside. And I think we are moving back to the upside. And one of the reasons why is just as we were going down, money was rotating more aggressively. And I find that to be a very, very bullish signal. So we'll see. I mean, that bottom's still holding. I don't know if it's going to. I think it will. But that's still the bottom. Now I wanted to just show you on the S&P the current action and where we are going into this meeting. You see again how we were trading down. Now we're kind of going sideways. Today we've got futures up a little bit. My guess is that we're just going to kind of go in a fairly narrow range until about 2 o'clock today. That would be my guess. S&P is probably going to trade, I don't know. I think within the day, it'll definitely be within 3830 and 3900. I'd be really surprised if it makes a big move in one direction before the announcement. The other thing I would watch is after the announcement, pull up something like, I like to look at this is a daily analysis with the S&P, and then I have my ratios that I like to follow underneath, my aggressive versus more defensive type ratios. XLP, XLY, XLP, QQQ, SPY, and then IWF, IWD. Those are just 3 that I would watch so that if the market does go down, are these ratios going up? If they are, I don't think that move to the downside will last. If we start to go back up, but these ratios go down, I'm not going to feel very good about that move to the upside. So again, these are just a couple of ratios that I would follow versus the S&P 500. And I like to do it intraday, which on this chart you can see, here's the S&P. This is over the last 10 days going down. But notice where we were before we went down, how much we went down. And look at where the XLY, XLP ratio was. It's actually gone up. So more money is rotated toward discretionary during this period of lower S&P prices. That's the good news. The bad news is QQQ and the Spider was going down, though they did go up yesterday. IWF was going down, but it's been going up the last couple of days. So we're starting to see a little bit of rotation back into some of those aggressive areas as the market does nothing. So if all of a sudden we get the announcement, and we do like we did a couple of months ago in June, and we leave all this basically down on an island, and we just take off back to the upside. We're going into the 4th quarter. I'm just saying, don't be shocked if that is it to the downside. If we gap up and we move higher after the announcement, and you see these ratios all going up with it, I'm going to be pretty bullish. All right, last couple of things I wanted to do. First, earnings this morning. General Mills, yesterday in my show over at Stock Charts, I did 3 upcoming earnings announcements. One of them was General Mills. This was the one I liked the best. AD line, very strong. Price action's been really nice. If you look at the relative strength relative to food products, we were at a 52-week high. We're very close to it. I thought General Mills was going to have a good report. They did. They came out, they were up, I think their earnings were $1.11 versus $1 expected. And pre-market, they're up more than 3%. So 77.84, right back up near the high. So that's how I use my charts when earnings are coming up. If I think a company's, if I think it looks good on the earnings, going into earnings, then I'm going to feel better. I'm still going to be nervous, but I'd feel better about holding a stock. I don't like holding a stock if it looks weak. So with that in mind, we have three for the final three you must see to wrap up today. We have three stocks that will be reporting today. Costco, I think they're all after the bell. But anyway, Costco is one. And I'm going to pull that up. No, not on that. I'm going to pull it up on a relative chart. I think the AD line looks pretty good. Price action's just been sideways, but that's good relative to the S&P. It's been decent against its personal products peers. I'm okay with Costco. It was stronger a few weeks ago, but I'm okay with it. Next up, ACN. This is Accenture. Here you got a stock that's been downtrending all the way back down near its recent lows. AD line doesn't look bad, but it's really about the only thing that doesn't look bad. Here's your relative strength versus the S&P near a 52-week low. Relative to software, it's doing okay, but go down the bottom panel, software is at a 52-week low versus the S&P. So it's an okay stock in a really bad group. And it's down here near this support area. I'll tell you, this one will be a little tougher to hold into earnings. I would be careful with ACN. And then the last one I'll show you is, I was going to pull up FDX. They report, but they just pre-announced a warning. So I imagine they're going to report about what they warned. So I'm not going to look at that one. FDS, this is FactSet Data Research. Very nice action here. AD line strong. Price action continues to be very strong. Look at the relative strength to investment services group. Very strong. I suspect you're going to get a nice pop here. I wouldn't be surprised to see FDS back up near 460 or above with its earnings. Anyway, that is it for me. Let's take a quick look at the market, see if we're holding on to these gains. Well, moderate gains. Like I said, I think we're probably going to meander today. I'll be really surprised if we have a strong day going into 2 o'clock. I'll be really surprised if we have a really weak day going into 2 o'clock. Normally, we just kind of don't do a lot. Volume kind of subsides and we wait. And that's what I would look for today. And what happens after 2 o'clock, like I showed you, expect up, down, up, down, up, down, and then something going into the close. And I don't know which way it's going to go. But what's most important is what happens over the next couple of days and what happens with those ratios I showed you. Anyway, that's it for me. Take care, everybody. Be careful. 2 o'clock, that's the big time for the announcement. We'll see what Fed Chief Powell has to say. Expect 75 basis points. Expect data dependent. Expect we need more than 1 month of data, and expect we are going to remain vigilant against inflation. That's what I'd be looking for. Anyhow, again, have a great day. Be back tomorrow over at Stock Charts TV for your next Trading Places Live. Happy trading, everybody.